In 1929, speculation was a faith. In 2008, debt became a business model. But 2026 feels older, like an empire finally meeting the bill it has carried for a century. The world is standing on a balance sheet written in gold and ink, in data and delusion. For 100 years, we've borrowed tomorrow to survive today, believing the next innovation would always pay the last debt. Stocks now worship 7 idols. Real estate floats above wages like a mirage. And bonds, the supposed safe room, burn quietly with the house. When everything is priced for perfection, nothing has a floor. History isn't repeating, it's compounding. Every empire keeps a ledger. Victories on one side, debts on the other. Rome had its grain, Britain had its colonies, America has its credit. The modern empire doesn't need armies. It has balance sheets, stock indices, and interest rates. Its power is denominated not in territory, but in confidence. Confidence that the markets will rise, that real estate will appreciate, that government bonds will always be safe. But the foundation beneath that confidence, the interest rate, the yield, the promise of repayment, has begun to shift. America's balance sheet now holds 3 great pillars: stocks, real estate, and bonds. Each once offset the others. Today they lean on each other like tired soldiers, wounded in the same war. In 1929, speculation broke the market. In 2008, leverage broke the system. In 2026, both forces arrived together, magnified by technology, amplified by time. Valuations stretch beyond history's comfort zone. Cash flows are pulled forward like borrowed breath. The story says innovation changes everything. The math whispers, only timing changed. This film is not a forecast. It is a forensic, an autopsy of optimism. What happens when the policy tools that saved us in 1933 and 2009 are already spent, and the refinancing wall of 2025 and 2026 arrives right on schedule? The stock market was once a mirror of the economy. Today, it is the economy's illusionist, creating wealth through reflection rather than production. In 1929, valuations soared on faith in electricity, the radio, and the automobile, technologies that promised a new world. In 2000, the internet carried that same promise. In 2025, the altar is artificial intelligence, and the congregation stretches from Wall Street to Shanghai. The S&P 500 trades at a price-to-earnings ratio near 28, nearly double the long-term average of 15. That number has only been seen twice before, in 1929 and in 2000. Both times, the euphoria ended in silence. But this time, the danger isn't just valuation, it's concentration. 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, now represent almost 1/3 of the entire S&P 500, 7 names holding the weight of a civilization's confidence. When an empire depends on 7 pillars, a single crack becomes an earthquake. Nvidia alone is valued at over $3 trillion, more than the entire German stock market, the world's 4th largest economy. Investors pay $65 for every dollar of profit. That is not analysis, that is devotion. The story is familiar. In 1929, investors said new technology made old rules obsolete. In 2000, they said the internet had rewritten economics. In 2025, they say AI will make growth infinite. The language changes, the psychology doesn't. Bubbles are not built on lies. They're built on truth told too soon. The internet did change everything, so did electricity, and AI will too, but not fast enough to justify the price of our impatience. Behind the charts lies a deeper rhythm, a market addicted to leverage. Companies borrow to buy back their own shares. Hedge funds borrow to amplify trades. Individuals borrow through margin and options, gambling not with savings, but with credit. In 1929, it was brokers' loans. In 2008, it was mortgage derivatives. In 2025, it is algorithmic leverage hidden inside ETFs and AI-driven trading. The forms evolve. The risk remains the same. Every generation believes its tools make it smarter than the last. But technology doesn't eliminate greed. It automates it. When machines trade faster than panic itself, liquidity becomes an illusion. The first wave of selling will not be emotional. it will be programmed. In 1929, shoeshine boys whispered stock tips. In 2025, influencers stream them to millions. The screens are brighter, the blindness identical. Every temple built on belief must one day face the ledger. When 7 names carry a century's faith in endless growth, the question isn't if they fall, it's who falls with them. Every empire builds monuments to its confidence. Rome raised temples, America built houses. The home became its faith and its favorite collateral. But housing only works when mortgages and wages rhyme. When the cost of shelter rises faster than the income beneath it, the roof becomes a burden, not a refuge. In 2008, homes were 35% above their historical trend. Today, they are 50%. That makes the current bubble 40% larger than the one that almost ended capitalism. We call it normal because it's been expensive for so long, but price stability by memory is still instability by math. Real estate was once a path to middle-class security. Now it's a market for leverage. Private equity firms buy entire neighborhoods. Ordinary families compete with algorithms that never sleep. But the quiet crisis is not residential. It is commercial. Office buildings stand half-lit at noon. Remote work emptied cities faster than any war or plague. San Francisco office space is 35% vacant. Nationwide, 45% of desks sit unused. These buildings were financed when money was cheap, 3% loans. Now they must refinance at 7 to 9. At 3%, the balance sheet worked. At 8, it bleeds. No spreadsheet can save a dream when the interest rate doubles. Over $2 trillion in commercial loans come due in 2025 and 2026. The refinancing wall is not a headline, it is a calendar. Each month brings a new wave of maturities, each more expensive than the last. When the math no longer works, owners hand back keys. Banks inherit buildings worth half their loans. Regulators arrive late, armed with spreadsheets and denial. Regional banks discover that held to maturity means nothing when maturity arrives. The crisis isn't driven by greed this time, it's driven by timing. Projects built in a world of cheap money must survive in a world of scarcity. Duration mismatch, the oldest sin in finance, returns. In 2008, we called it subprime. In 2025, we call it commercial real estate. Different labels, same gravity. When the foundations crack, it is not the skyscrapers that fall first. It is the small-town banks that funded them. And once trust in property is gone, the very idea of security goes with it. Housing, once our shelter, has become our mirror, showing what we refuse to see, that prosperity built on leverage is not wealth, it's weather, and the forecast has changed. In every past collapse, bonds were the lifeboats. When stocks drowned, investors climbed into treasuries and waited for the storm to pass. But 2025 is different. This time, the lifeboats are leaking. The U.S. government has crossed $36 trillion of debt, a number so large it has outgrown imagination. That's 125% of GDP, the same level America held at the end of World War II, but without the post-war boom to rescue it. Back then, the United States was the world's only unbroken economy. Today, it is one debtor among many, competing with nations that borrow less and produce more. The annual interest payment on this debt now exceeds $1.2 trillion, more than defense, more than Social Security. Interest has become America's largest expense and its smallest return. In 1929, bonds were the safe harbor. In 2008, they were the refuge. But in 2025, they suffer the same disease as everything else, overissuance. The more the state borrows, the less safe its promises become. Every auction now feels like a test of faith. Will the market buy another trillion? Will foreign holders keep believing in a currency that pays for its own depreciation? The bond market is no longer the doctor that cures the patient. It is the pulse that reveals the fever. When yields rise to attract buyers, mortgages, corporate loans, and bank capital ratios all tighten. Relief for one becomes pressure for all. This is the paradox of our age. The asset meant to protect the system now transmits its pain. A bond crash is not a headline. It is a slow erosion of trust measured in basis points and belief. The Federal Reserve cannot cut rates to zero. They're already low. It cannot print without rekindling inflation that still haunts the public's memory. And it cannot raise taxes without breaking growth. The trilemma is complete. To service its debt, the government must either cut spending and create a recession, raise taxes and create a recession, or print money and create inflation. Each path leads to the same destination: loss of purchasing power. When interest becomes the largest budget line, the empire no longer works for its people, it works for its creditors. History calls that moment the beginning of fiscal serfdom. Once bonds were the foundation of the world's trust. Now they are its fragile roof, and as yields rise, the structure beneath them creaks. If confidence is the currency of empire, then 2026 is the year it comes due. The bond market was once the anchor of the system. Now it drifts, and the rest of us drift with it. Crashes never begin with an explosion. They begin with a whisper, a missed earnings report, a bad auction, a quiet bank sale announced on a Sunday. At first it feels contained, a single problem in a single sector. But the system is interconnected by code, not confidence. One default triggers another. One margin call ignites a chain reaction. In 1929, panic spread through telegrams. In 2008, through derivatives. In 2026, it will move at the speed of algorithms. Machines don't hesitate, they sell instantly. Within seconds, thousands of orders hit the market, indexes gap, liquidity evaporates. The first wave of selling is not emotional, it's mathematical. Risk systems reduce exposure automatically. Portfolio managers wake to screens bleeding red. The algorithms don't sleep, they just adjust. And the adjustment is always down. When stocks fall fast, brokers issue margin calls. Investors sell to raise cash. That selling pushes prices lower, triggering more calls. It is a feedback loop that feeds on fear. In 1929, shoeshine boys were ruined by leverage. In 2025, it will be pension funds and algorithms fighting to exit the same door. Within days, the Magnificent Seven could lose 20 to 30%. That alone would drag the S&P down nearly 10. The machines will call it a rebalance. History will call it a reckoning. Institutional funds have rules. When losses hit 20%, they must sell. So they do. Automatically. The cascade accelerates not because of fear, but because of policy. Meanwhile, bond markets absorb none of it. They fall too. The safe haven turns into the same fire. The Federal Reserve faces a trap. Cut rates and reignite inflation, or hold them and watch the economy freeze. Either path leads to pain. But the difference this time is speed. What once took months will unfold in days. Commercial banks begin to fail one by one. Depositors move funds to safety, but there is no safety left. The FDIC's insurance fund is a thimble trying to catch a wave. Then the contagion moves from markets to people. Layoffs, credit crunches, frozen salaries, confidence, the true currency of modern finance, evaporates. And so, the cascade completes its circuit. Stocks fall into bonds, bonds fall into currencies, and currencies fall into memory. Every empire has its run on the bank. For Rome, it was grain. For Britain, gold. For us, it will be trust. When markets collapse, it isn't the numbers that suffer. It's the people behind them. Every red candle hides a heartbeat. Every percentage lost in the index erases years of quiet sacrifice. A 40-year saver watches his retirement vanish. He did everything right, saved, invested, waited. Now the system he trusted erases 3 decades with a keystroke. He stares at his statement, not in anger but disbelief. A teacher delays retirement. A nurse picks up extra shifts. A young couple cancels their wedding because the mortgage broker stopped returning calls. This is what a financial crisis sounds like. Not screaming traders, but silent kitchens. In 2008, millions lost their homes. In 2026, millions will keep them, but lose the illusion that ownership means safety. Their equity fades while interest remains. The house becomes an anchor that keeps them still when the tide of opportunity rises elsewhere. Small businesses, once the backbone of the real economy, will break first. not from mismanagement, but from mathematics. No sales, no credit, no cushion. The cash register becomes a mirror reflecting the emptiness of the street outside. Young graduates enter the workforce with diplomas but no doors to open. The generation that was told to follow its dreams will learn the oldest lesson of all, that stability is a luxury, not a guarantee. History calls it a recession, but to those inside it, the word doesn't fit. It's not a cycle, it's a season, cold, gray, and uncertain, where everything once steady feels fragile again. Governments will promise relief, checks will arrive late, programs will run dry, inflation will fade from headlines but not from grocery aisles. The poor will grow poorer, the middle class will shrink, and the wealthy will wait, as they always do, for clearance prices on distress. We'll see the same faces we saw in 1931 and 2009. Men standing by closed factory gates, families leaving homes with furniture wrapped in silence, children overhearing their parents whisper about money as if it were a secret shame. This is the real cost of the everything bubble, not the losses measured in trillions, but the erosion of trust. Once people stop believing that effort leads to security, the social contract tears quietly, thread by thread. A civilization built on credit is really built on faith, and when faith collapses, it cannot be bailed out. It must be rebuilt slowly, through honesty, work, and memory. Every crash ends with numbers recovering, but the people rarely do. The body heals before the soul, and history never forgets the silence that follows. Every empire believes it can control its own collapse, that it can manage decline like a balance sheet, adjust, refinance, recover. But history doesn't negotiate. It simply collects what's due. When the dust of the crash settles, the headlines will speak of stabilization. Markets will bounce. Commentators will call it resilience. But what returns isn't confidence. It's habit. And habits, like debts, always come back with interest. Governments will announce reforms. Central banks will promise precision. Commissions will investigate everything except the human condition that caused it. The same incentives, the same greed, the same short memories. We never rebuild differently. We rebuild faster. The survivors will adapt. The rich will buy what the desperate must sell, and the cycle will restart, slower at first, then faster, as if forgetting were a form of healing. Yet something permanent changes after every reckoning. In 1933, trust in banks died. In 1971, faith in gold died. In 2008, faith in the system died. And in 2026, it may be faith in the future that dies. The quiet assumption that tomorrow will always be better than today. But decline is not destiny, it's a warning. Every civilization gets a chance to learn before it falls. Most simply choose comfort over clarity. We borrowed too much, trusted too deeply, and assumed the bill would never arrive. It always does. When historians look back on this decade, they won't see a crash, they'll see a correction, not of prices, but of pride. A recalibration of what wealth means and what progress truly costs. Maybe we needed this, to remember that paper profits aren't protection, that algorithms can't replace accountability, that no chart can predict human fear or human resilience. Some will rebuild stronger, humbler, and wiser. Others will repeat the same cycle, convinced this time will be different. But history has no patience for denial. It simply resets the scoreboard and waits for the next empire to over-leverage its faith. If 1929 was the crash of valuation and 2008 was the crash of debt, then 2026 is the crash of illusion, the end of believing that prosperity can be printed. Empires don't fall in a day. They fall in interest payments, in promises rolled over, in trust withdrawn. And when the ledger finally closes, it will say what history always says at the end of every cycle. We were warned, we didn't listen, and we paid in time what we refused to pay in discipline. History doesn't repeat. It settles its debts.